Meanwhile, my next guest says while the recent sell-off has been unpleasant, it's not that unusual, and you should still be buying the dip, including overseas. Let's bring in Jared Woodard. He's the head of the Research Investment Committee at BofA Securities. Jared, before jumping ahead, do you want to just talk about what continues to ail this market? What do you think it is?
Yeah, Governor Evans, I like that in the last segment. The call is right that there are some real stresses emerging on the minds of consumers and of businesses. But I think that there's a very open question about how much of that is a forward-looking assessment of what could happen in public policy data and economic data and how that'll affect the market. That's a very different way of thinking about the world than what we're used to contend with as investors. Conditions are what they are, and there's uncertainty about what it means for investments. This is a second level of uncertainty that's obviously showing up in a lot of survey data, so-called soft data. And our view is that the best guide for this year is going to be hard data that shows what people actually do, how they spend, and how they invest, not just what they say.
Right. So does it worry you that we saw some softness in consumer spending this morning?
There was a little bit of that, although I think when you look at the broad swath of hard data, whether it's industrial production or retail sales or other measures, there are the job market most of all. There are some pretty strong data points still on the table.
Yeah, Jared,
if those were to weaken, you'd have a different story.
Absolutely. Well, let's turn back to Jared Woodard, shall we? Now that we have an IPO data point, does that tell you anything, Jared, one way or the other, about sentiment about the market?
I'm not sure it's a huge tell, honestly, Kelly, but I think there's a broader context that is really important in which investors are taking a more forward-looking approach to markets than they do even under normal circumstances. And that's why we think that getting confirmation of both the risk and the rewards that are on people's minds is more important than ever. And for that, we want to look at hard data, not just economic hard data, but also data from the markets, earnings, returns, and where markets are allocating capital today. I think it's incredibly important. And there you're seeing some signs of life in parts of the market that you haven't normally seen as big winners over the past 20 years, including stocks around the world and some other factor assets.
What do you do with that? You think that is now the place to kind of follow, to put your money to work, international value?
Yeah, I mean, our thesis this year has been that it's a year for allocators, not for benchmarkers. So far, that seems to have been borne out well in the returns. U.S. value stocks are outperforming U.S. growth stocks so far this year, I think by more than 8 percentage points. Gold is up 17%. Defense stocks, which have been under some concern about whether government budget cuts would affect them, are rallying nicely. Defense tech is rallying even more sharply this year, and those are all accessible ways in the market, whether stocks or in ETFs that we cover. SHLD is a great defense tech name that we cover, and I'd have to mention U.S. quality because so many investors have portfolios that are heavily weighted toward growth and towards tech, and it's not that you shouldn't own those, you should. But we found that a lot of the screens for quality in a fund like JQUA, which we cover, is able to offer access to high-quality stocks without increasing your exposure to the large-cap tech names that so many people already own, to bring back some diversification that's been a little bit missing in some of the major benchmarks.
We're showing their IWD value outperforming sort of growth this year by 10 points, so that's pretty significant. So is that kind of your answer for what you do with technology? Is it not a lot?
Well, I think you need to wait for better confirmation. There's been such a run-up in sentiment on the back of enthusiasm for artificial intelligence. Companies have spent a lot. There's been a lot of capex. I think we're starting to see comments about a desire for revenues and for visible improvements in productivity at the corporate level, having made all those investments. It may be that enthusiasm for mega cap tech and for artificial intelligence needs another fundamental catalyst before there's more upside to be had there in a narrow way. We think no matter what the fact is, you've got to be more diversified, and that requires a little bit more reach beyond just familiar benchmarks to add back the exposure, whether it's internationally like in Japan or India or domestically in U.S. value and U.S. quality.
And there's the Mag 7 down another 3% today. Finally, what is gold telling you? What do you make of it?
I mean, gold's the classic safe haven. I think when people used to think about gold as an inflation hedge, there's still some truth to that. It also tells me, I think this is really important, that investors around the world want to be diversified too. And so you've seen 3 straight years of record buying of gold by central banks around the world. If you plug that into your model, along with inflation, along with the dollar, along with interest rates and so on, what you find is that you can explain those moves pretty well. As long as investors around the world want to be diversified across currencies, across hard assets, across real assets, I think there's continued upside for gold. And our colleagues at Bank of America just raised their gold price forecast, I know, after it passed the 3,000 mark.
Incredible.